Press the bell icon on the YouTube app and never miss another update.
Omega Limited is working on different projects which are likely to be completed within 3 years period. It recognizes revenue from these contracts on percentage of completion method for financial statements during the 3 years which are given for 11, 16 and 21. However, for income tax, it has adopted a completed contract method under which it has recognized revenue of so and so. Income tax rate is 35%. Compute the amount of deferred tax asset or liability for so and so years. Now we know as per accounting standard 7, you should be recognizing your revenue from construction contracts following the percentage of completion method. So in accounts, we are following the percentage of completion method. However, when it comes to income tax, we are following what is allowed for income tax, and what they are saying is that for tax, we are following a completed contract method. Now see, the total revenue that is going to be earned in accounting records and what is going to be taxed in tax obviously is going to remain the same, but its timing can be different. So this will again give rise to a timing difference, and we know that timing differences will eventually result into deferred taxes. So let's show what can be the deferred taxes. So once again, give the heading in your books, computation of deferred taxes. Just give the heading, computation of deferred taxes. The 3 years are 2014-15, 15-16 and 16-17. Whenever you start preparing this statement, always put the first figure which is the higher one. If the accounting figure is higher, then put the accounting figure. And if the taxation figure is higher, then put the taxation figure. The first year. 2014-15 is the first year. Now in accounts it is 11 lakhs, while in tax it is 7 lakhs. So start with accounts. So we say A, accounting income. $11 lakhs, 16 lakhs, 21 lakhs. Next, taxable income. First year 7 lakhs, 18 lakhs, 23 lakhs. Take a difference. That's your timing difference. 11 minus 7, 4. 16 minus 18, 2. 21 minus 23, 2. Take a total of the timing differences now. That's your cumulative timing difference. The first figure is 4 lakhs. 4 lakhs, whatever answer you are getting, add 2 lakhs to it. So 2 lakhs and this 2 lakhs and this 2 lakhs. You can even say 0 or just put a dash. Apply the tax rate now. Tax rate. $35. Right. So 4 lakhs I will multiply by 35%. It's turning out to be 1,40,000. So that's your deferred tax. Now the most important thing. Is it deferred tax asset? Is it deferred tax liability? What is it? Okay, there was some problem in the recording of the earlier episode, so we'll just continue. My apologies for that. Okay, so we reached a very crucial stage, a stage where we are supposed to decide that whether this is going to give rise to DTL or is it giving rise to a DTA. What is it? A deferred tax liability or a deferred tax asset? And please decide this in a very logical manner. Don't try to devise some shortcuts that if this will happen then DTL and if this happens then DTA. No, please don't do it in that way. Go as conceptually as possible. And what exactly is the concept? How can I do it conceptually? Do it in this way. In the first year where the timing difference is originating, right? In that year we have to ask ourselves that because of the timing difference, am I paying less tax? If you come to the conclusion that you are paying less tax, that means in future you will be liable to pay more. And if you are liable to pay more in future, you should recognize a deferred tax liability. It is also possible that in the first year, because of the timing difference, you are saving tax. Or, because of the timing difference, you are now paying more tax. Because you are paying more tax, in future, you may save tax. Then it is something that will give rise to a deferred tax asset. So, in a very logical manner, we should do it in the first year. No shortcuts. Don't go by what you internally feel. You feel like, okay, this will be DTL, so you say DTL. And if you feel like it is DTL, so I'll DTL. I'll tell you, there are so many students that get confused over here. I've seen so many students, the way they solve, the way they solve it, till here they are all fine. Then here they will say deferred tax. They will not even write whether it is deferred tax asset, deferred tax liability, because they are confused. So they will simply say deferred tax, and then they will complete the entire question. Deferred tax closing balance, deferred tax opening balance, deferred tax for the year. So this is what so many students do. And when I see that solution, it becomes very clear that the student is not very, is not clear with the concept that whether it will be a deferred tax liability or deferred tax asset. So let's go conceptually, let's try to understand. We don't want to be one of those kind of students, right? So tell me, what will we do? See the first year. See, in first year, your accounting income is 11 lakhs and your taxable income is 7 lakhs, isn't it? That means your taxable income is lower. Tell me, your taxable income is lower. That means you will pay. If taxable income is lower, that means you will pay less amount of tax. If you are paying less amount of tax in the current year, that means in future you will be liable to pay more tax. Simple. I should recognize deferred tax liability. You can yourself observe in the figures. Just see. In the current year, my taxable income is lower. But look at the next 2 years. Taxable income is 18, higher than 16. Taxable income is 23, higher than 21. I hope you are able to get it. In the current year, my taxable income is lower. I will be extremely happy because I have to pay less amount of tax. But the income tax department is like, okay, celebrate in this year, no problem. We will catch you in the next year. This is what will happen. They will catch you in the next year because in next 2 years your taxable income will be lower. Whatever tax that you save in the current year, you are liable to pay that in the next year. Understand this thing from the accrual principle of accounting. Only payment of tax is getting postponed. Liability is already crystallized. When the current year ends, I know next 2 years I'll end up paying more amount of tax. So that's the reason I should recognize deferred tax liability. You now know what is to be done. Since you have done the earlier question, you know what will be needed to be done. We will say deferred tax liability, DTL. You can say in brackets, closing balance will be D into E. 140, 70, 0. DTL, opening balance is the very first year, so it does not have any opening balance. DTL for the year. In the first year, we are saying that we will end up paying 1,40,000 rupees of tax in the subsequent 2 years. So this is DTL recognized. And whatever DTL that I am recognizing, what I am saying in the first year is that in the next 2 years I will have to pay 1,40,000 rupees of tax extra. And as you pay that extra tax, reverse it. So reverse the DTL. If you are still writing, you can pause the video and complete it.
Press the bell icon on the YouTube app and never miss another update.